Hey guys, it's Nick. It is now official that the S&P 500 has now had its worst first half of the year performance in 60 years. So, how bad is it? And does it mean that the worst is probably already behind us, or is it just beginning? So, let's take a look at the historical data to give you an idea of where we are and where we might be going. So Zero Hedge has a really good article with a lot of charts, and the headline says stocks worse in 60 years, but even worse, it was Bitcoin's worst ever first half also. So here's a chart of the S&P 500, the first half performance. And so it is officially down 21.22%, which is larger than any first half drawdown since 1960. So being down 20% in the first half is even bigger than the great financial crisis and during the internet bubble when it reached about minus 12 or 13% in the first half. So this is like 50% worse than that. And speaking of the internet bubble, this is the NASDAQ first half performance, and it is the worst ever, going all the way back to 1972. And bigger than during the internet bubble as well. So the NASDAQ is down almost 30% in the first half compared to the internet bubble was about 25% down in the first half. And looking at all the different sectors in the first half, the only one that's positive is the energy sector, and that's been coming down recently also as well. So the next best performer after energy would be utilities, which is only down 2% in the half of the year. And the next one would be consumer staples, which were only down 6.4%. And the worst is consumer discretionary, which was down about 32.5%. So not only were stocks really bad, so were U.S. Treasuries. And so here's an idea of how bad it is. Most of the worst years for treasuries were down less than 2%, except for 1994, which was down 4%. Here, we're down over 6%. So this is the worst on record. And so to wrap your head around how bad this really is on a global scale, this is the global equity and bond market cap change in the first half in trillions of dollars. So normally, it's up 5, 7, 10 trillion. In 2021, it was up about almost 14 trillion or something like that. But all these years, the worst year was 2008 when it was down about 7 trillion. Well, we are down a combined 31 trillion or so. And so if all of this is happening because the global central bank balance sheet has gone down from like 25 trillion to 24 trillion or so. Imagine what happens if they really do quantitative tightening like they claim they're going to. And so you see here in 2020, before the pandemic, the global central bank balance sheet was about 14.5 trillion, and it peaked around 25 trillion in 2021, 2022. And so even natural gas, at least in the US, is coming down because the Freeport LNG terminal is going to be closed longer than expected, and just generally energy has been coming down in price, except for in Europe, where this is the oil barrel equivalent price compared to WTI crude, which is around 105. The US natural gas price is like 94, but the EU natural gas price is like 246, or about 2.5 times greater than the US natural gas price. So is there any potentially good news looking forward in the stock market? Well, let's take a look at what Carl Quintanilla said. This series goes back to 1946, and it is the quarterly drop percentage in the S&P 500 and what the next quarter, next half, and next year actually returned. And so the worst quarter was September in 1974, dropped 26%. The next quarter was up 7.9. By the next half, it was up 31%, and the next year was up 32%. So this is what he's trying to say, is that when there's a big drop in a quarter, more than 15%, Usually the next quarter, next half, next year are positive or even very highly positive. So the average next quarter would be up 6%, the average next half would be up 15%, and the average next year would be up 26%. Now, this is true, but we are in kind of a little bit different situation right now that doesn't match up with all of these downturns. And the number one thing is stagflation, which is a stagnating economy and inflation. And so the Atlanta Fed GDP forecast is now negative. Just last week, it went down to 0%, and now it is now forecasting negative 1%. So basically, they're saying we are in a recession already, or we're heading into a recession. And the University of Michigan expected change in prices during the next year, 5.3%. So higher inflation and a recession or stagnating economy is not a positive for the stock market. So what is positive for a stock market? Well, all you have to do is look at this chart. This is the Fed balance sheet in black, and this is the S&P 500 index in blue. And so you see, 2008, the Fed balance sheet was at 1 trillion, and now it went as high as 9 trillion, and it's come in to about 7.5 trillion now. But just look, as the Fed balance sheet goes up, meaning lowering interest rate, buying up bonds, the S&P 500 is highly correlated to what the Fed is doing. And when they stop doing that, this is what happens to the S&P 500. And if you want a good approximation of what this is like, if you've ever driven an electrical bicycle that you can pedal and you have the electrical assist on and you feel like you're flying and everything is great, and then the battery dies and all of a sudden your bicycle feels like a 1,000-pound motorcycle that you're pedaling along the street. This is kind of what happens when the Fed turns off the taps and increases interest rates. And so more and more investors are coming to the realization that we are probably heading into a recession if we're not already in one. And so the rate hike expectations just as early as June 14th were for like almost 4%. Now they are like 3.4%. And the rate cut expectations went from being about minus half a percentage point to being down to like minus 0.84 percentage points. So people are expecting that the recession will come and the Fed will have to turn around, and instead of raising rates, they're going to have to start cutting rates again. And that's what the market is hoping for. And so if you step back and take kind of an aerial view of the S&P 500 going all the way back to 1994, you see that the last two bottoms in 2002, 2003, and 2009, they both bottomed out when the MACD, the monthly MACD, was way under the zero line and crossing here and here. And the price was under the 50-month exponential moving average, this green line. So this is now just touching from above the 50-month exponential moving average. So if we are going into a bad recession, this is not going to bottom out until this flips down like this. And some people are saying the bottom could be the S&P at 3,000. If it is as bad as we started off in the first half, I expect it's probably going to be worse than most people are saying right now. So brace yourself for lower prices, maybe closer to the COVID bottom. Who knows? So it looks like things will get worse before they get better. And the only real savior of the market is if the Fed comes out and says, okay, we're in a bad recession now. We're going to stop the quantitative tightening and go back to quantitative easing and lowering interest rates, at least until inflation spikes again. So I don't think we're going to see a bottom for a while, and I haven't really seen capitulation. People are still buying the dip. So until that ends and people are fearful and the VIX goes up, I don't think we're at a bottom or near a bottom yet. So invest accordingly. Thanks for watching, guys. I'll see you in the next one.